Dalal Street snaps its 4-week gaining streak to end in the red, but banks buck the trend as the index sees green for the 7th straight week. On today's edition of the Editors Roundtable, we bring a Q2 earnings report card. We tell you what to expect in Q3. We also put a spotlight on IT stocks. Have they made a comeback? And we also see if the Nifty companies are on track to hit 6.5 lakh crore rupees in profits. I'm Sonia Shenoy, and I have all the editors here with me, Anuj, Prashant, Nimesh and Nigel. Folks, it's been a week where we've sort of consolidated. There is a bit of fear of heights, but by and large, not such a bad week.
Yeah, not such a bad week, especially the close on Friday actually gives you a lot of comfort. It tells you that ahead of the weekend, people are willing to buy the dip and buy the plunges. The only worry that I have about the market, actually two worries, Sonia, is that now that the earnings season is over, I don't see any trigger for the market to move up, unless it's just momentum investing. And B, the lot of complaint that I got this week was that while we keep talking about Nifty at 18,600, a lot of people's portfolios are still stuck at 17,600. I think the last 1,000-point rally has purely been large cap driven, and that perhaps is, if you're nitpicking, maybe you can look at that.
Saying, right? The market is getting narrower and narrower of late. In the last 4 weeks, it's only the few large cap names, some banks or maybe Reliance or some large caps who's pulling the Nifty up. But broader markets, you've seen some bit of profit booking and bit of underperformance as well. So that's been the trend for the last couple of weeks. It's getting narrower and
caps,
narrower.
right? And a lot of liquid mid caps, which are owned by HNIs, retail. You're seeing real price damage. I mean, stocks are down. We're at all-time highs, but look at a lot of these sectors. I mean, footwear stocks is one we've been highlighting constantly. I mean, even some of these defense stocks are starting to pull back a little bit. I mean, I think we saw that on Friday. To my mind, the only comfort is so late into the year. I mean, for all practical purposes, I don't know about your holiday plans and how many weeks you are here now for the end of the year. But so late in the year, it's very unnatural for the market to start a completely new trend.
Yes.
Whatever the trend is, that kind of more or less continues, and the trend has been okay. It's been intact. It's been higher. So hopefully, I mean, we don't have to wait.
Ajay was telling us right in the week that this is the time, perhaps. Ajay Srivastava was telling us this is the time, perhaps, to just. If you've made money in the year, or if you've not, just take some time off. Go for a holiday, enjoy your spoils. But I think what's really stood out for me this week, and a couple of points. As I said at the start, the Nifty ended its 4-week gaining streak. But what stood out is what happened with the Bank Nifty this week. The Nifty Bank gained for the 7th straight week. And over there, this was the longest gaining streak that we saw in the Nifty Bank. And what really stayed with me this week is Morgan Stanley's note. And we had an interview with the banking analyst as well, where he said that there is a second leg of re-rating that's underway in a lot of the banks because of two reasons. One, loan growth is coming back in a big way. And two, there is capex acceleration, especially from the private space, and that could perhaps lead to a bit of a re-rating for the banking sector. And the stocks that could benefit the most in the second leg of this re-rating is companies that have access to high retail deposits, whether it's ICICI Bank, Axis Bank, SBI. But remember, these banks are not cheap anymore. SBI is now trading at almost 1.5 times price to book FY24. So, you just got to keep that into perspective. But give and take everything, it was a rather good week and a lot of bullish commentary on the banking space. But Nimesh, overall, for the market, what was the feedback from the dealing rooms?
Well, Surya, the big standout for me was the fact that the broader markets have started underperforming. And there are now serious signs of profit booking. Prashant spoke about the defense stocks, or for that matter, the footwear companies. They all have been underperforming. So there were signs of profit booking now in the broader markets. And the other thing is, what Anuj has been pointing out, every now and then, that the retail investors have become very smart and they time the market very well. And that's what something to watch out for. For the quarter ended September, the retail investors were net sellers, and they were net sellers of close to almost $2 billion at the time when the FIs have net bought. Even in the month of November, month to date, the FIs have been net buyers of $3.5 billion. But that, of course, accounts for the fact that there were so many blocks as well. But the other part is, after a very long time, the FIs are net long more than the retail net long in the index future. Again, that's a sign which Anuj keeps pointing out, that normally at 800, the retail was net long and the FIs were net short. I think that is reversed now at 18,600. So that's something to, maybe the retail would again will be right this time as well. That's something to watch out for in the next few weeks to come from here. In terms of liquidity, we saw large blocks. We all have been highlighting about the lock-ins opening up. So $500 million worth of blocks did happen between Paytm and PB Fintechs and all, and it got easily absorbed. Again, next week, at least to my knowledge, there is $200 million of blocks lined up. The delivery, lock-in actually it ends today. So maybe early next week, we'll see a large block in delivery as well. So that's something, the liquidity aspect is something to watch out for, and that's having a impact on many stocks. Like PB Fintech got hammered. Paytm was down 12-13% when there was a large block. So I guess that's something to watch out for. But two key takeaways. One, a bit of profit booking in the broader markets, and the fact that the retail investors have paused a bit and they're actually not putting big money. I think that something tells you that maybe again this time the retail investors may go right. But I guess now that the earnings season is over, Prashant, I think you've done some number crunching.
Yeah, I mean, and the earnings, they don't paint a very flattering picture because, I'll go across to the wall and kind of explain this because at the end of the day, in any reasonable time frame, stocks are a slave to earnings, right? And this is what I'm calling it, the earnings growth challenge. Let me explain this. Now, this is, what earnings have done all the way from 2012 to 2023. These are Bloomberg consensus. Now, this is not what earnings have grown or degrown in any particular year. What this shows is the earnings downgrade from the first time earnings for a particular year come. Say, for example, we are now in FY23. Earnings for FY25 the first of FY25 earnings will come. From now all the way till when the actual earnings for FY25 appear by the end of FY25, what is the delta? What is the change? Are earnings getting upgraded through the course of this period, or earnings being downgraded? And this is what it tells us. For 10 years in a row, all the way from 2012 to 2022, we had earnings downgrades which were happening. We got a small upgrade in 2012 by about 1.6% or so. And in 2023 so far, they've been downgraded by almost about 5% once again. Now, the reason I'm not looking at actual earnings and expected upgrades or downgrades is because what matters to stocks is incremental movements, upgrades or downgrades based on beats or misses, right? That is what stocks react to. Now, this is how the FY23 Nifty 50 net profit expectations have moved. The expectation in March was, that number, this is all in rupees billion. In November, it hit 6067. And in November, right now, after the second quarter earnings have finished, we are at about 6536 billion rupees, which is a downgrade of about 5% from 2 quarters ago. Now, this number that we are right now still implies that over actual FY22 earnings, it is almost a 14% growth. But, if you talk to individual brokers, some marquee brokers, they're below consensus. So Kotak is now at 11%. The consensus is at still close to 14, which is good. CLSA is now saying, well, perhaps we'll end up with, around 8-10% kind of numbers. And Jefferies is also kind of penciling in under 10% earnings growth, which is not good news. I mean, there's a 5% downgrade and more is expected along the way. Now, take a look at this. 34 of the Nifty 50 companies have seen FY23 earnings estimates being cut. So this is clearly, a bit of a worrying sign. So the biggest earnings downgrades coming in Tata Motors, JSW Steel, BPCL, Ultratech, a lot of commodity names, as you can see. And that naturally, some of it was expected. Some, in some cases, the misses are larger than what was expected. And the top upgrades are coming through in Coal India, Axis, Bajaj Finserv, and Titan. The reason why FY23 is important because, it becomes the base for FY24 because will the same thing happen? You estimate something and you, through the course of the year, bring the estimates lower. I just want to leave you with this. The negative argument to this earnings debate is that earnings are the biggest driver for stocks. They've been falling. Estimates have been falling for 2 quarters in a row. You can give a positive spin and say earnings cuts in India are still lower than those in other emerging markets. And that will be true. But this is the point, being positive on India versus other emerging markets, and this is a constant thing we hear, right? We are doing much better fundamentally, earnings-wise, macro, etc., and all of it is true. But that is different as opposed to being positive in an absolute sense. What matters to our viewers, to everybody watching, is how much do you make in an absolute sense? Just because some other market did a little poorly, does not lead to you making gains. You need to do well in absolute terms. And that is where I think earnings matter so much. But, I've looked at what the second quarter has done to estimates, but let's look ahead beyond 23 to 24. And Nigel has done some number crunching as well. Nigel, it's over to you.
Well, Prashant, I'll take off from where you left. In fact, let's put it in cricketing parlance. We need to bat twice. We know who are going to be the big batsmen out there. And the tail enders as well, they're not expected to do too much. So they could be the swing factor that will play out. What I'm getting at is the Nifty profitability, as Prashant said. For this year, we should be ending at around 6.5 lakh crore approximately. For the next year, that's FY24, we're looking at a number of close to around 7.6 lakh crore. So that's an incremental 1.1 lakh crore. Now, out of the 6.5 lakh crore, how much have we achieved? Around 2.95 lakh crore, which means the second half of the year, we're likely to do around 3.55 lakh crore to achieve that 6.5 lakh crore. Who are going to be the big contributors? Obviously, big boy Reliance Industries is going to be in there. You have SBI, HDFC Bank, TCS, as well as ONGC and the likes. So these 7 stocks, they're going to contribute close to around 50% of this 3.5 lakh crore that we're expecting in the second half of the year. Now, for the following year, that is FY24, as of now, the street is baking in a 1.1 lakh crore increase in the profitability. So the number we're looking at is around 7.6 lakh crore odd. And out there, TCS is coming up the order actually. It's up, it's expected to contribute a little bit more. While you have Bharti Airtel as well that's making the list. But the crucial number is going to be the incremental number. That's the 1.1 lakh crore. And who's going to contribute out there? Reliance Industries close to around 18% is going to come in from there. And these 5 stocks that come up on the screen, well, they are going to contribute close to around 60% of these earnings. That's the 1.1 lakh crore that we're talking about. The tail enders I was talking about, well, that's these 3 stocks that come up for you. That's ONGC, Tata Steel, as well as Coal India. They're expected to see a profit degrowth of close to 20,000 crores. That's what the street is factoring in. That's why we're factoring that 1.1 lakh crore. So if they either disappoint more or they don't, come in with this degrowth, then that could be the swing factor that plays out. And it's all going to be about earnings, right? Because we're not cheap. Price to book, PE, whether you're looking at market capitalization to GDP. So just thought that we put out these numbers. The big numbers, the chase is on for the Nifty. Let's see whether we get there because the targets are set. But Anuj, the big debate has been, have IT stocks bottomed out? And you have done some number crunching and some valuation check on that as well. Tell us more.
Yeah, Nigel, for last 2 weeks, I'm trying to put a bit of an ahead of the curve sort of analysis on, how people can benefit. Last week we spoke about Kotak, maybe that's bottomed out. This week we're putting a spotlight rather on IT, whether that's bottomed out. Now, early days yet, I must say, but signs are encouraging. And after a long time, actually, I personally am looking at IT rather positively. Now, this is what the indices have done, and Indian IT index has actually mirrored Nasdaq's performance. Nasdaq has rallied about 10% from the lows, and Nifty IT has also rallied about 13% from lows. And look at the distance from the top. For the Nasdaq, it's a good 31%, and for the Nifty, it's a good 25%. So make no mistake, they are still in bear market. But what was the catalyst? The last US inflation number was a big catalyst because that led to belief that the interest rates might be soon to peaking out. And if that is the case, then the whole worry about the valuation reset could be coming to an end because the IT space is very sensitive. In fact, it's the most sensitive to US interest rates. Now we need to see if the US avoids recession. That I think is very important. Now, look at very interesting data. This is the Nifty IT stocks. They saw FI inflow of $317 million in October 16 to 31 period. This is the period when the FIs actually started to buy in Indian market after consistent selling. This is first decent buy in IT in nearly 15 months. November 1 to 15 data is not available. My sense is you would see an encore of that. I think it's explained best by a picture. The picture would come up for you. Look at that blue bar. That's the October 15 to 31. You'll have to go all the way back to 21 to have that kind of number. Other than that, FIs were consistently selling all the IT stocks. So that's a big change. Now the earnings season ended, so I was just looking at what happened. What was very interesting was that despite all the fears, the revenue growth remained quite healthy for IT companies. In fact, large cap IT companies delivered 2.9 to 4% QOQ revenue growth, which is quite good. And the deal win also remained quite robust, though the management commentary was a bit cautious. The other important parameter, which is important from the valuation point of view, is that the trend of decline in EBIT margins reversed. EBIT margins are still below pre-COVID levels, but at least they're better than what they were, say, a couple of quarters back. The only worry here, and this is a courtesy an ISEC report, is that the headcount addition moderated to 2.2%. Why is that important? Because the revenue growth and headcount growth, they move in tandem. If you look at this picture, this will beautifully explain for the last many years, this is how revenue growth and headcount growth move absolutely in tandem. I mean, revenue growth goes up, headcount growth goes up, revenue goes up. So if revenues, if headcount has fallen to 2%, then that's a bit of a worry. That's the only worry. But the one picture which gives me a bit of a comfort now is the valuation picture, because I'm old school, I look at valuations. TCS current valuation is 26.7 times, way off the peak of 34. 5-year average 25, very close to that. Infosys 24.8, and Infosys has got a bit of a re-rating. versus 32 peak, 21.5 the average. Look at Wipro. Wipro has actually fallen below its 5-year average. It's 17.2. Its peak was 29. It's below its 5-year average, and that's HCL Tech. 19 is the multiple. Average was 16. But you get a sense that they're not horribly expensive, which they were about 6 months back. And I think the next plate would explain this in terms of individual stocks. This is TCS's forward P. In November 19, this is where TCS used to trade. Look at what the peak valuation was. Look at where the trough valuation was and where we are now. You could argue that we are now in some kind of a mean reversion. Infosys, this is where the valuation game started. It reached at its peak there, bottomed here, and now again we are close to the average. Wipro, I think Wipro beautifully explains this. 17.23, we're practically at almost average valuation, and HCL Tech as well. Even if you look at these as charts of stocks, you will get a sense that these were in uptrends, had a decline, and that uptrend is getting reversed. So again, I'm saying that early days yet, but signs are there, Sonia, that IT stocks might just be bottoming out.
Okay, and I guess at the end of the day, a market is all about finding stocks at reasonable valuations, right? Where there's valuation headroom, and clearly, as you saw that chart, there is perhaps more valuation headroom in IT stocks. Let's step into a quick break. When we come back, we'll discuss market fundamentals. We have Mihir Vora of Max Life Insurance joining us in just a bit. Stay tuned.
Welcome back. You're still with us here on Editors Roundtable. We have a special guest, as always, here in our studios with us. Mihir Vora is Chief Investment Officer at Max Life Insurance. Mihir, great that you could make it with us here. Appreciate your time.
Always a pleasure.
We were talking about earnings and whether markets are getting enough help from earnings. And if you take stock of Q2, the answer is clearly no. There is all this relative outperformance and relative optimism vis-a-vis other markets. But at the end of the day, earnings need to accelerate, which is not happening. Is that a concern?
Yes and no. On one side, you have this huge chunk of earnings, the stock of earnings which is in financials, especially the banks. They look pretty robust for the next at least 1.5 years. So till FY24, I don't see a problem with almost 50 to 60% of the Nifty EPS composition. So there, I think we are okay. And the couple of places where we have seen downgrades in earnings is basically in the metals and the commodity space, basically, which had run up too much in any case. But those have a low PE in the overall market. So that is a cyclical component. Probably the markets will look through. The concerning area would be in the discretionary and the consumer segment, where we have seen significant margin pressures. So my guess is that companies have been taking price hikes to the extent possible. And if the rural economy, which has not allowed really FMCG companies to take price hikes to the extent required, if the rural economy turns around, then we should see FMCG and auto companies also come back on the margins front. So yes, it is a cause for concern, but I would wait to take a call for at least a quarter or more before getting negative about it.
Okay. Well, it's really nice to see you in person, by the way. I think we've chatted for years remotely, and great to have you here with us in the studios. I don't know if you got a chance to look at the piece that Anuj had put out about IT stocks, and valuations are looking compelling now. Is this a good time for long-term investors to be, putting a chunk of money here?
Well, it will depend on what your domestic economy view is. If we are positive on the domestic economy, which I am, then IT will continue to underperform. That's my view. And I think Prashant was mentioning, I was just listening into the conversation earlier, that ultimately it's not necessarily the absolute level of earnings that matters, but the trend of earnings. Yeah. So if you're seeing upgrades in a sector, then you probably will have re-rating continue and the PE will continue to go up. And in the case of IT, we are beginning to see downgrades and slowdowns, which means that the PE may not be, sustainable. So even if you see say 3% downgrades in IT stocks, earnings estimates, you probably might see the PE, relative PE to the rest of the market come down. So I'm a big fan of earnings upgrades, downgrades, and I think IT sector will continue to see some downgrades. That's why I continue to be negative on that.
Mihir, good evening. The big debate is on banks. The outperformance of ICICI and SBI for last 3 years, and now the erstwhile outperformers, the HDFC banks and Kotaks of the world, they are catching up. How are you playing this whole theme?
See, in financials per se, I think the banks are, as I said, for the next 18 months, I see as being winners. And the whole game now within the financial space is about liabilities. there is going to be a scramble for liabilities. Banks will need credit growth, and it's already happening. So I think all the non-bank financials, whether it's NBFCs or even the other segments of the financials, will face competition from the liability scramble from banks. And I think banks with huge liability franchises, deposit franchises, will continue to outperform. The big will get bigger. Branch networks will start mattering again.
Does that mean, Mir, that within the financials you'll only look at banks and avoid the NBFCs, MFIs and small finance bank? Is that a big call?
That's the call, yes. Okay. Because liabilities is going to be theme, at least for a few months.
The liability side of the PSU banks, which by the way have been the stars of this year, they're pretty strong, right? And that's what will hold them in good stead. What's your take on them? That re-rating everyone's been talking about, well, the index itself is up 45% in this year. PSU banking index. The SBI has been the pick, the consensus pick. But the other few banks, that's where the money has been made. Too late to get onto that bus, or still there is some cushion out there?
There is a cushion out there because I don't see NPA cycle deteriorating at least for a few quarters for PSU banks. But hand on heart, I would play PSUs as cyclical plays. So while the private sectors have led the charge, there's always going to be a valuation catch up. But they are not a long-term structural story still because of the traditional issues of mission, vision, management, whatever you call it.
Okay, well, in case we don't meet again, Happy New Year to you. We're getting into the festive season, so hope you have a great one. And thanks once again for joining us here in the studios on Editors Roundtable. Appreciate your thoughts as well. Well, with that, it's a wrap on another edition of Editors Roundtable. Thanks a lot for watching. See you folks again bright and early on Monday.